Good evening and welcome to yet another weekly forum from Smartkarma. I'm very happy to have you guys attending today. Just as we wait for people to stream in, I'll go over our disclaimer. The weekly forums are meant strictly for subscribers. They're purely for informational purposes. They do not constitute investment advice. They represent the opinion of our insight providers and not that of Smartkarma. And lastly, but importantly, Chatham House rule applies. So please do not share any of this information on social media or any other public forum without express permission. Now, when we begin every week, we try and take a little peek back into prior weeks and what was presented. We do that for two reasons. First, we like to explore the breadth and depth of ideas that are shared, but we also, like to show how we structure these sessions. So every week we like to start off by typically we start off by looking at a small cap. Then we move on to a large cap idea. The small caps are typically companies that are not so well covered. And the large caps are typically ideas where we have a very, very mean variant of view, and there's something sort of interesting and important that we want to highlight. And lastly, the third part of the section is always a thematic piece where we try and look at either something that's important as an investment opportunity, or perhaps it could be, looking at market conditions or positioning or something. So last week, for instance, in our small cap section, we looked at Razer. This is a Singapore company that's listed in Hong Kong and makes computer and mobile peripherals. And we took a real deep dive into how things are turning around at the business and how this company is aggressively buying back its own stock, but it's not very well covered, and hence it could be a really interesting opportunity. We also took a look at the upcoming IPO of JD Logistics. And we looked at what would be the read across from that IPO to JD, the parent company. And the third bit that we looked at was a very interesting and unique bit of research on SPARS, which was a fictional pandemic that was written about 3 years ago, and how a lot of the material in the case study is very similar to actually how COVID is unfolding, and hence what lies ahead of us. So, we examined that. The week before that, we looked at Oriental Watch. This is a stock that's actually done really, really well in recent days since we started flagging it. We took a look at a cyclical called China Communications Construction, which is trading on just 0.2 times book and 2 times PE, but is showing very rapid growth now. And, we gave a bit of a warning that, things look quite precarious in May, and we informed, attendees on places to hide. And look, a lot of that is actually unfolding over the last 2 weeks. So once again, every week, typically, there's a small cap, a large cap, and a theme. The second thing we always try and do is we try and keep things very real. So every idea that gets presented is tracked. Now, the reason here is very simple. We want to keep on top of the ideas. We want to make sure we not only bring new ideas, but we bring you updates on prior ideas too. And the importance here is not so much sort of, representing performance, because this is literally just the average return of every idea presented, but it's more to make sure that research is accountable and that ideas can stand on their own feet. So as you can see, despite markets actually being very weak in March, again in sort of April, May, things have been reasonably well. Of course, if you look at the latest month, you never really see very good return. You have to give ideas some time before they kick in. So this week, we're actually breaking rules a little bit. So we're not talking about any small cap today, but we're looking at three things. First is we're looking at Toyota Motors. This was an idea discussed, I think, in December, where we talked about how Japanese autos look excellent. And within that, we discussed a barbell strategy, a large cap and a small cap, and Toyota was the pick. Toyota is listed both in Japan as well as in the US, so you can buy the ADR if that's required. Secondly, we will look at Alibaba. This is an idea that was presented in, I think it was in March. It's actually an idea that has not worked. well so far, and we want to revisit this post its recent results. And we're going to talk about what's looking good, what's not looking so good. And then lastly, in our thematic section, we will discuss what could potentially be the most significant tail risk in the region, which is a potential military escalation in the Straits of Taiwan. So let's kick things off. So first things first, we're going to look at Toyota. As I mentioned, this is listed in Japan, but it's also listed in the US market. It's a large cap, market cap is about $220 billion. It trades nearly $500 million a day, so it's very, very liquid, very, very actionable. You can see from this chart on the right, the little green circles represent a bullish view. So we've been very regular and very, very positive on this stock for quite a while now. And let's look at the the thesis here. So first things, right? People have criticized Toyota for not having electric vehicles or for lagging behind in electric vehicles. But we've had dogged conviction that Toyota is a very different kind of company. When they move in a very determined way, and they don't often agree with the crowd. So Toyota held back from announcing its own EV strategy for a long time. But then in April this year, so last month, they announced not one, not two, but 70 new electrified models by 2025. In classic Toyota fashion, they've announced their own technology. It's a little bit different from what else is out there. They're not as big believers in lithium ion, so they will be trying, different variants, even hydrogen technology in the years to come. So that's quite exciting. Now, no one can criticize Toyota for not having a clear, determined, well-defined strategy for electric vehicles. Then, soon after that, in the month of May, Toyota had its results, and the results, really sort of blew past all estimates. Now, this is a very well-followed large cap company. So when a company like this beats estimates, you've got to pay attention to it. Most importantly, the profitability was a lot higher than the street expected. And also what was great is that in the results, Toyota began to give detailed disclosure around electric vehicles. So again, you're getting future direction and you're getting present results. Thirdly, and this is perhaps the most important point, Toyota really cares about its shareholders. They have really started to focus their attention on improving shareholder returns, not just by declaring better profits, but also by raising dividends. So despite it being a pandemic hit year, Toyota raised its dividend. This also tells you the strength of its balance sheet. Fourthly, Toyota has announced a 5-for-1 stock split, which will happen in September. This is obviously great news for a lot of retail investors who might find, almost $100 share price a little bit inaccessible. And in the same breath, they have also resumed buybacks. So I think this year they plan to buy back 2% of the company. That would be nearly $5 billion worth. And they're going to potentially continue doing that next year as well. This is all fantastic. And Toyota is not gearing up. They're not taking on debt to buy back equity. Instead, they're using their balance sheet, which is extremely strong. So all in, right, the company is really going through a transformation. It is no longer just a very reliable auto company. It's been that for many decades. But apart from that, it's becoming a company that's very innovative. It's building stronger emotional connections with customers. And a great example of this is if you look at the Super Bowl ads that Toyota has been putting up for the last several years, you will notice how they've started to change very, very nicely. And Toyota's ads today, you would not even know they're from Toyota. You might even think they're Apple's ads, for instance. All in, you're getting a stock that's trading on just 1 times book, 0.9 times price to sales, rising yield, more buybacks, and a lot more growth ahead. So it looks like a great large cap to buy on any sort of pullbacks. And if you look at the chart on the right-hand side, the black line is the revisions. So the street is just having to revise upwards and upwards and upwards. So, Toyota is really on, has great momentum, and, it's accelerating basically. That's Toyota. Now, you guys can ask questions at any given point of time. I may or may not be able to answer them, but the analysts who cover Toyota on the platform will certainly be able to. So we will post these as discussions if we cannot be answered now. So use the Q&A button on your Zoom app or use chat, whatever works, keep them coming. But meanwhile, I'll move on to the second idea. So as I mentioned, we're going to be looking at Alibaba. We're going to be, understanding, or rather we'll be looking at the results more closely and seeing whether our thesis is intact or not. So first things right, the stock's done basically nothing for a year. The share price today, which is just above $200, is almost back to where it was this time last year. Meanwhile, a lot of things have improved. So let's take a look first of all. So when you look at the headline numbers of Alibaba, it shows a profit decline. Well, that's actually wrong, because the operating profit actually did not fall. The reported number included a penalty of 18.2 billion RMB. This is a one-off. If you adjust back for this one-off, actually the operating profit for the March quarter would have been up almost 50% year on year and 18% on a full year basis. So it's actually at a core operating level, really solid profit growth. Secondly, revenue growth was also extremely strong at 64% for the quarter, 41% for the full year, and this easily beat consensus expectations. Now, part of this revenue growth came from them consolidating an acquisition of Sun Art. Now, for those of you who might not know, Sun Art is actually a hypermarket in China, and Alibaba completed the acquisition of Sun Art last year. So now they're consolidating the numbers. So by right, you should strip this out. Even if you strip this out, you get a 39% increase in revenue. So here you have a $500 billion market cap company that's growing revenue 40% a year, that's growing profit 50% a year. So that's pretty good. Thirdly, just like Amazon has cloud computing, so does Alibaba. And the cloud computing business is now turning profitable. So this is the chart on the right-hand side. After investing in this business for many quarters, it has now broken even. In fact, it's gone profitable. EBITDA margins are still small at about 2%, but that's still really good, because now you no longer have cloud as a drag. Instead, you have it as a growth drag. Next, Alibaba is largely out of the crosshairs of regulators now. A lot of the damage that had to be done is done, whereas a lot of its competitors are only just starting to feel the heat. Great example is Meituan, which is a stock we've sort of loved to dislike on Smartkarma. Now, looking forward into the rest of the year, operating margins for the company are going to continue to rise. So analysts expect that they'll go from 12% to 15%. That's quite a lot, that's a big delta. That means this year, profit growth at the operating level could be 61%. I mean, that's extremely high growth for a company, for the valuation that the company has, and given the fact that share price has not done anything in a year. So, all in, we have to take stock and say, these results have nothing in there that derails the thesis. The focus on improving profitability and returns to shareholders continues. This is a big cap company that's showing what I call hyper growth. So that's a real scarcity. Okay. I've got a couple of questions coming in, so I'll tackle them before we move on to the last section. So first question, any preference buying Japan Toyota versus the US line? They're actually fully fungible ADRs, so there is no arbitrage as such here. Personally, I mean, I would just buy the Japan line, but I think there would be attendees here who don't trade Japan but trade the US. Either way, there's no real difference here. Second question that I have is, how does Baba compare with JD in terms of valuation? So it's a really, really good question. JD is actually trading a little bit more expensive at the moment. JD on the e-commerce side has a very different business model. So Baba runs a marketplace. So, it's got third-party sellers and buyers interacting on its platform. JD, on the other hand, has balance sheet. It buys the products and then sells them. So the unit economics is very different, and the comparison gets a little bit murky. Short term, I think I'm fairly indifferent here because JD's got a bunch of catalysts that are short term. They're listing the logistics business, then they're listing the fintech business on the A-share market. But I think from a regulatory perspective, Baba looks better because a lot of the negatives are out. But I think also some of the subsidiaries, they're very, very similar. They both have fintech businesses. They both have great healthcare subsidiaries. They both have e-commerce businesses also. So I don't know, maybe just split it 50-50 and not take a single company risk. Sorry, not that decisive an answer, but I think very similar sort of profiles, although slightly different business models, I feel. Cool. I'll keep on moving. The forums are meant to be rapid fire, open mic style sessions where, we try and get through these in like 20-25 minutes. Okay. So next, geopolitics. So, this is quite big. And I think this is not something that the market should ignore. Last year we ignored COVID and look where that brought us, right? Like this year, I think we cannot ignore what's happening in Taiwan. So on the right-hand side, you'll notice a chart which shows that the Taiwan market has done very, very well, and also secondly, it's amongst the most well-owned markets, at least in Asia, from foreign buyers. It's been a real darling market. But what's happening right now is worth looking at. So let's go through this, right? So you had a brief reprieve during the US elections, but sort of soon after that, China-Taiwanese tensions have escalated, and they've escalated really sharply. There's been multiple breaches of Taiwan's air defense by Chinese warplanes. Interestingly, the Taiwan Air Defense has a website where they actually give you live disclosure whenever there's an incursion, and there's been multiple breaches, basically. In fact, the breaches are getting more and more rapid and bigger in size. So what is a breach? This is typically, Chinese Air Force planes flying over Taiwan. And that's obviously something that makes people in Taiwan and the government of Taiwan uncomfortable. Thirdly, the US APAC commander, Philip Davidson, actually came out very categorically and said China would invade Taiwan in the next 6 years. Now, I would say it's rather uncommon for such a statement to be made in such a decisive manner. So it's something that turned the attention of the media. Next is if you guys are following geopolitical news, you might have heard of this term called the Quad. So the Quad is a new alliance of sorts that is being formed by the US. It's led by the US. And it's literally a bit of a cooperation amongst countries that is opposing China. So as this alliance is getting stronger, China's retaliation seems to be picking up as well. And recently, the Quad elevated cooperation on what they call as the Taiwan emergency. Again, very, very strong words. Lastly, there's been really a barrage of very high-profile op-eds all over the news just over the recent weeks, highlighting this tension. So if you look at the charts on the right-hand side, these colorful charts, they're produced by one of our research providers called Ilan Gore, who does natural language processing work on, publicly available news and media. And what you can see is that, all these indicators are moving up. These indicators capture the risk being associated with military escalation in press and in popular media. So that there's clearly a surge up, and it hasn't died down. It's continued to accelerate since these charts were made. Secondly, I think I would like to point out that the Taiwanese dollar, which is this last chart, this is the chart of the currency, the Taiwanese dollar is extremely strong as well. So, what's happening here is that it's not only a well-owned market from an equities perspective, but in terms of overall capital flows into Taiwan, they've also been very, very strong. And this represents the interest in the semiconductor space where Taiwan is a leader. Now, one interesting way to position or hedge against a potential further escalation is to look at the currency. Given how elevated the Taiwan dollar is and given how weak the US dollar is, some people might want to take some out of the money puts in the Taiwanese dollar as a potential hedge. So again, this is a thematic section. So we just want to make sure that you are highly sensitized now to this theme, because this is a theme that's not going to go away. If anything, it's going to pick up and escalate further from here. So with that, we're at the end of today's presentation. I'm happy to take more questions. We've had another question come in. This is, other than regulatory headwinds, Baba is likely to face the same inflationary rising interest rate headwinds other tech stocks face. Baba also lost its perceived monopoly status, which made it a darling. What would the trigger points be for Baba to make a turnaround? Okay, I think there's a few points here and some great points to clarify. So first of all, you're talking about inflationary rising rate headwinds for tech stocks. I think that needs a little bit of clarification. So inflation is not necessarily a bad thing for tech stocks. Inflation is a bad thing for long duration assets. What that means is companies that do not have present cash flow, but most of their cash flow is in the future, they are badly affected when inflation rises. Baba does not fit that camp because it has great cash flows and profitability right here, right now. So if you look at even NASDAQ companies, right? The Googles, the Apples of the world have actually not really been hit by inflationary pressures at all. These stocks have done very well year to date. Conversely, a lot of the stocks that have conceptual earning streams, they don't have cash flow or earnings today. They're just great stories. Maybe they have revenue. They're the ones that get impacted. Simple, right? Because for these stocks, you typically value them on some sort of a discounted cash flow, but bulk of the cash flow is in the future. So as rates rise, the denominator rises very sharply and it dampens the cash flow in the future. So that's why. So I think that's quite important. I would not say higher inflation is a blanket ban against tech stocks. In fact, tech stocks can do extremely well during inflationary times. It just depends on what type of tech stocks. Second, Baba has lost its perceived monopoly status. Well, maybe that's a misconception or a misperception. For one, I don't think anyone, even I, saw monopoly as, Alibaba as a monopoly. We saw it as a leader, definitely, but not necessarily a monopoly. And yes, it is in some ways no longer as much of a leader as it used to be, because companies like Pinduoduo, companies like JD, they've also grown. However, I think the devil is in the unit economics. Pinduoduo has never been able to show a profit. We've discussed Pinduoduo as a short idea on this forum before as well. So there are companies who've tried to gain market share by aggressive discounting. They've not displaced the ability that Baba has to make profits for now. And I think your last question is, what could be the trigger points for Baba to make a turnaround? I think that's a fantastic question. To be honest, one trigger point is just clarity that the regulatory risk is behind you. And frankly speaking, it seems that for Baba, at least, that is the case. For a lot of the other Chinese tech companies, that is not the case. That's one. I think the second is Baba has the balance sheet to continue to do buybacks, which I think it will do. And I think sooner or later that will make a difference. And lastly, I think some of these things go in and out of fashion as well, right? So I think another 1 or 2 quarters of strong results, and people will have no choice but to chase Baba. You know, if you're on 25 times PE, but you're growing 60% a year, by next year, you know, you're going to be on like high teens PE, and that makes you extremely cheap as a large cap, right? So I think partly this is a time correction that will just pass as well. So hopefully that answers that question. Another question I have here is, how does the Taiwan risk affect TSMC? Well, I think in a very, very big way, in a very profound way. You know, in many ways, TMC sits at the nexus of, you know, why there is geopolitical risk. You know, the semiconductor sector expertise that Taiwan has and the market share that Taiwan has is obviously of huge strategic interest to China and also to the US. And that semiconductor expertise, of course, largely sits within TSMC. And you can see how the US is trying to forge deeper alliances with TSMC to build a bit of a guard against China. But, you know, so I'd say that, you know, the war on Taiwan will largely be fought within the confines of TSMC. Of course, I'm talking about a proverbial war here. Really hope that this doesn't go beyond just military escalation. But yeah, it definitely does affect TSMC. Also, another thing to note is, as we mentioned, Taiwan's a real darling market. And the biggest overweight by far is TSMC. In fact, TSMC is one of the most well-owned names across Asia by investors anywhere. So that's obviously a risk too, just because of how well-owned it is. And even in the last week or 10 days, as the Taiwan market has cracked, you know, TSMC has come off as a result also. Fundamentally, though, you know, we are in a multi-year bull market for semicon and memory. So that's, you know, that's the opposing force there, right? Fundamentals look good, but the prevailing geopolitical risk is, I think, getting too big to ignore. Great. Well, thank you for those questions. You know, if you have more burning questions, please send them our way or post them on the forum. I've got one administrative announcement. I shared this last week as well, but next week would be our last forum before we take a little break in the month of June. And then we will be back again in July. During the month of June, we will be taking your feedback and some of our own ideas to make this forum even more useful for all of you. But thank you for your attendance and your questions, and speak next week. Bye now.